silver has crossed $90 per ounce. The United States Mint, one of the world's most reliable sources of physical precious metals, is experiencing significant production and delivery delays. These two facts, appearing simultaneously, are not coincidental. They represent something deeper happening in financial markets, something that demands your attention regardless of whether you own silver or have never considered it. I'm not here to tell you that silver is going to make you wealthy. I'm not here to predict where prices will be tomorrow, next month, or next year. What I am here to do is help you understand what's actually happening, why it matters, and how you should think about it as someone who takes their financial future seriously. The movement in silver prices and the stress on physical supply chains tells us something important about the relationship between paper markets and physical reality. It tells us something about investor psychology during periods of uncertainty, and it tells us something about the challenges facing traditional financial systems. Whether you own silver, gold, or no precious metals at all, the dynamics we're witnessing right now offer valuable lessons about market structure, risk management, and how to maintain rational thinking when markets start moving violently. This is not a moment for excitement. This is a moment for clarity. Let's begin by understanding exactly what we're looking at. First, let's establish context. Silver spent much of the past decade trading between $15 and $30 per ounce. The metal has experienced significant volatility throughout its history, but sustained price levels above $90 represent territory we haven't seen before in nominal terms. When we adjust for inflation and look at real purchasing power, silver reached higher equivalent values during its 1980 peak and its 2011 surge. But nominal prices matter psychologically, and they matter practically for anyone making decisions today. The question isn't whether $90 is high or low in some abstract sense. The question is, what forces are driving this movement, and what do those forces tell us about the broader financial environment? The U.S. Mint delays are particularly significant because they represent stress at the retail level of the physical market. When the Mint, with all its resources and priority access to silver supply, cannot keep up with demand, we're seeing a disconnect between available physical metal and the number of people who want to own it. This isn't the first time we've seen this pattern. During 2008, 2011, and again in 2020, physical premiums exploded and delivery times extended dramatically while paper markets traded at different prices. What we're experiencing now may be more severe. Why does this matter? Because it reveals something crucial about market structure. Silver trades in multiple forms. There are futures contracts, which are paper agreements to deliver silver at a future date. There are exchange-traded funds that claim to hold silver on behalf of shareholders. There are allocated and unallocated accounts at bullion dealers. And then there is physical metal in your possession or in segregated, allocated storage. These are not the same thing. They have different counterparty risks, different liquidity profiles, and during times of stress, they can trade at dramatically different effective prices. When the Mint faces delays, it's because physical demand has overwhelmed physical supply chains. Meanwhile, futures contracts continue trading electronically with no immediate requirement for physical delivery. This creates the conditions for a two-tiered market, where paper prices and physical acquisition costs diverge. Silver occupies a unique position in financial markets. It's both an industrial metal and a monetary metal. It has a smaller market than gold, which means it's more volatile. And it has passionate supporters who view it as undervalued relative to gold, undervalued relative to historical ratios, and undervalued relative to monetary expansion. Let me be direct. Emotional attachment to any asset is dangerous, but understanding why others have emotional attachment helps you understand price movements. Silver's industrial demand comes from electronics, solar panels, medical applications, and numerous other uses. This demand is relatively inelastic in the short term. Companies need silver to manufacture products, and substitution isn't always practical or cost-effective. Silver's monetary demand comes from investors seeking to preserve purchasing power, hedge against currency debasement, or protect against systemic financial risks. This demand is highly elastic and highly psychological. When both forms of demand increase simultaneously, you get significant price pressure on a relatively small market. Silver's total above-ground supply and annual production are tiny compared to currency markets, bond markets, or even gold markets. Now let's look at the factors driving current demand. We cannot discuss precious metals without discussing monetary policy and sovereign debt. This isn't political. This is mathematical reality. Global debt levels, both government and private, have reached historically unprecedented levels as a percentage of GDP. Central banks have expanded their balance sheets dramatically over the past 15 years. Interest rate policies have created distortions in asset valuations across multiple classes. These aren't conspiracy theories. These are publicly available facts that appear in Federal Reserve statements, Treasury reports, and central bank balance sheets worldwide. When debt levels are high and central banks have limited tools remaining, investors begin questioning the long-term stability of fiat currency purchasing power. This doesn't mean the dollar will collapse tomorrow. It means rational people start considering how to allocate some portion of their wealth to assets that don't depend on any government's promise to pay. Precious metals have served this function for thousands of years. They're not perfect. They don't generate cash flow. They can be confiscated by governments under extreme circumstances. But they represent value that doesn't depend on a counterparty's ability to honor a debt. Right now, we're seeing several macroeconomic signals simultaneously. Inflation readings remain elevated in many categories that matter to daily life, even when headline numbers moderate. Real interest rates, when you subtract actual inflation from nominal rates, remain questionable. The differential between official inflation statistics and people's lived experience of rising costs creates uncertainty. Geopolitical tensions have increased, driving safe haven demand. Banking sector stress, while not currently acute, has created lingering concerns about financial system stability. Currency debasement continues globally as governments struggle with debt servicing costs. Each of these factors alone might not drive significant precious metals demand. Combined, they create an environment where more investors, both institutional and retail, consider allocating to hard assets. Here's what you need to understand about markets moving quickly. Psychology changes at different price levels. When silver was at $20, most investors ignored it. When it crossed 30, some began paying attention. When it breached 50, more jumped in. At 70, it became dinner table conversation. At 90, people who have never considered precious metals are suddenly asking questions. This is the momentum phase of a bull market, and it's the most dangerous time for your decision making. During momentum phases, recency bias dominates. People extrapolate recent price movements into the future. Someone sees silver rise 20% in a month and unconsciously assumes it will continue rising at that rate. This is irrational, but it's how human psychology works under conditions of excitement. Fear of missing out becomes a powerful force. Nobody wants to be the person who could have bought silver at 90 when it's trading at some higher number in the future. This fear drives poor decisions, causes people to allocate more capital than appropriate, and sets up conditions for severe emotional distress when inevitable corrections occur. Equally dangerous is recency bias in the other direction. After a significant correction, people who didn't buy earlier convince themselves they should wait for lower prices that may never materialize. Understanding these psychological patterns doesn't make you immune to them, but awareness is the first step toward maintaining discipline. Every market cycle is unique in its specifics, while remaining similar in its patterns. What makes the current environment particularly notable? First, the degree of physical market stress appears more severe than previous episodes. The combination of strong industrial demand from green energy applications, investment demand from macro uncertainty, and potential supply constraints creates a different dynamic than 2008 or 2011. Second, the retail investor base has changed. More people now trade markets directly through apps and platforms. Information spreads faster. Social media creates feedback loops that amplify momentum. This doesn't change fundamental analysis, but it does affect volatility and the speed of moves. Third, the institutional context has shifted. More large investors and hedge funds now consider precious metals as a standard portfolio allocation rather than a fringe holding. When large institutional flows combine with retail momentum, moves can be more dramatic. Fourth, the state of the broader financial system coming into this move is different. We're not in the immediate aftermath of a financial crisis. We're in a period of relative stability with underlying stresses that many investors suspect, but few want to acknowledge publicly. This creates a different risk profile. In 2008 and 2011, precious metals rallied during obvious crises. Currently, we're rallying while stock markets remain relatively strong, and conventional wisdom suggests everything is fine. This divergence is worth noting. Let's return to the mint delays because they illustrate a critical concept in financial markets. The difference between theoretical supply and accessible supply. Theoretically, there's plenty of silver. Annual mining production continues. Industrial recycling provides additional supply. Above-ground stocks exist in various forms. So why can't the mint keep up with retail demand? Because supply chains are not infinitely elastic. Refineries have capacity limits. Minting facilities have capacity limits. Distribution networks have capacity limits. When demand surges, suddenly, these systems cannot scale instantaneously. Moreover, silver must be refined to specific purities, formed into specific products, and delivered through specific channels. You cannot simply pour industrial silver into coin blanks. The process takes time, equipment, and labor. When retail investors want physical metal right now, and the mint is telling them there's a multi-week or multi-month delay, a premium develops. People pay more to get metal from other sources. Private dealers charge higher premiums over spot prices. Secondary market prices for existing coins exceed new production costs. This premium is telling you something. It's telling you that physical demand exceeds the immediate capacity of distribution systems. It's not necessarily telling you that prices will continue rising indefinitely. It's revealing a snapshot of current market stress. These premiums have historically been temporary. Supply chains eventually catch up. New production comes online. Prices rise enough to reduce demand or increase supply. Markets clear. But during the period of dislocation, the experience of trying to acquire physical metal is very different from the experience of trading futures contracts or ETF shares. This matters enormously for your strategy. This is perhaps the most important question and the most difficult to answer with certainty. Bull markets in precious metals tend to follow patterns. They begin quietly, with prices rising, while most investors remain uninterested. They progress through increasing volatility, with corrections that shake out weak holders. They enter momentum phases where prices rise rapidly and mainstream attention follows. And they end in euphoria, where everyone believes prices can only go higher. Where are we currently? That depends on your time frame and perspective. If you believe we're in a long-term bull market that began when silver was at its lows around $15, then $90 might represent a mid-cycle position. There have been corrections along the way, but the overall trend has been higher. If you believe this is a shorter-term move driven primarily by current year factors, we might be in a more advanced stage of this particular surge. I cannot tell you which perspective is correct. Nobody can. What I can tell you is that being aware of cycle psychology helps you avoid the worst mistakes. During early phases, the mistake is not taking any position when risk-reward is most favorable. During middle phases, the mistake is being either excessively aggressive or paralyzed by uncertainty. During late phases, the mistake is confusing momentum with permanence. Right now, with prices at $90 and mainstream media beginning to cover silver, we are clearly not in an early phase. Whether we're mid-cycle or approaching a top is unknowable in real time. This uncertainty is precisely why you need a disciplined approach. If you bought silver at $20, $30, or even $50 per ounce, you're experiencing significant gains. This creates both opportunity and psychological danger. The opportunity is to secure those gains in a rational way. The danger is that greed and fear of missing further upside will cause you to hold too long and give back profits during the inevitable correction. Let me be clear, there will be a correction. Silver does not rise in a straight line. Every bull market experiences sharp drawdowns that feel catastrophic while they're happening. If you cannot emotionally handle a 20 to 30% pullback from current levels, you need to reduce your position size now. Here's a framework for thinking about your holdings. Ask yourself what your original thesis was for buying silver. Was it a short-term trade based on expected price movement? Was it a long-term wealth preservation allocation? Was it a speculation on monetary policy? Your answer determines your appropriate action. If you bought as a short-term trade, you should have a profit target and a stop loss. If you don't have these, you're not trading, you're gambling. Consider taking at least partial profits here. Markets that move quickly in your favor also move quickly against you. If you bought as a long-term allocation, ask yourself if your allocation percentage still makes sense. If silver was 5% of your portfolio at $20 and is now 12% at $90, you've experienced significant concentration risk increase. Rebalancing isn't about market timing, it's about maintaining your intended risk profile. Many experienced precious metals investors use a scaling approach. They sell small portions at various price levels, taking some profits while maintaining core positions. This approach sacrifices maximum theoretical gains for reduced psychological stress and guaranteed profit realization. Consider this. If you sell 20% of your position now, you've locked in real gains that can be redeployed elsewhere. If silver continues higher, you still participate with 80% of your position. If silver corrects sharply, you have capital to add back at lower levels, and you've reduced your paper loss stress. There's no perfect answer. But the worst answer is to hold everything simply because you cannot decide what to do. Don't fall into the trap of calculating gains only from your personal cost basis. Your cost basis is irrelevant to current decision-making. The only question that matters is, would you buy silver at $90 today if you had cash and no position? If the answer is no, you should sell at least some of your holdings. If the answer is yes, holding makes sense. Your past purchase price is a sunk cost. It's psychologically real, but it's economically meaningless for current decisions. Silver at $90 either represents good value or it doesn't, regardless of what you paid for it. This sounds obvious, but in practice, most investors cannot overcome this bias. They hold losing positions because they don't want to realize a loss, and they hold winning positions because it's only profit if I sell. Both perspectives cause poor decisions. If you're going to maintain or add to precious metals holdings at these levels, position sizing becomes critical. Precious metals should be a percentage of your total portfolio, not the dominant holding, unless you have extraordinary conviction and risk tolerance. Most financial advisors suggest 5 to 15% of net worth in precious metals for those who choose to hold them. Above 15%, you're making a very aggressive bet. At $90 silver, if you're above your target allocation, reduce. If you're below it and believe in the long-term thesis, you can add in small increments. But adding a large position at these levels requires either tremendous conviction or recklessness, and it's difficult to distinguish between the two. Consider the mathematical reality. If you add to a position at $90 and silver drops to $60, you need a 50% gain just to break even on that particular addition. If you add at 90 and it rises to 110, you've made a nice gain, but the risk reward at these levels is very different than it was at lower prices. If you don't own silver and are considering buying for the first time, you face a different psychological challenge. The fear of missing out is extraordinarily powerful when assets are rising rapidly and media coverage is increasing. Here's what you need to understand. Buying an asset that has already moved dramatically is speculation on momentum, not investment in value. That doesn't make it wrong, but you must be honest about what you're doing. If you believe silver is headed to 120, 150, or higher in the relatively near term, then 90 might seem reasonable. But what if you're wrong? What if we're at or near a local top? Can you emotionally and financially handle a significant decline? Before buying anything, ask yourself these questions. Why am I considering this now? If the answer is because price is rising, that's a warning sign. If the answer is because I believe long-term monetary conditions support precious metals allocation, that's more rational. How much am I considering allocating? If it's money you need in the next year or two, don't buy volatile assets. If it's money you can leave untouched for years, you have more flexibility. What's my plan if price drops 20, 30, or 40% from here? If you don't have an answer, you'll make emotional decisions during a correction. Am I buying because I understand the asset or because I'm afraid of missing out? Fear is the worst investment advisor. If you've never owned precious metals and want exposure, consider starting with a very small position. Buy enough to pay attention and learn, but not enough to cause significant financial or emotional stress. This approach accomplishes several things. It gives you real exposure to the asset so you can experience how it moves and how you react emotionally. It prevents you from making a large allocation at potentially poor timing. And it gives you capital available to add if prices correct. Many successful investors build positions over time, adding in tranches at different price levels. This isn't about perfect timing. It's about avoiding the concentration risk of putting significant capital to work at one specific price point. If you want, say, $5,000 in silver exposure, consider buying $1,000 now, $1,000 in a month, and spreading the rest over the subsequent quarter. Yes, you might miss some upside if prices keep rising, but you also protect yourself from buying everything at a local top. This approach requires patience, which feels difficult when prices are moving. But investing is a multi-year endeavor, and temporary price movements matter far less than your overall process. Given the mint delays and physical supply constraints, you face a decision about how to gain exposure. Physical metal in your possession is the most direct ownership. You have no counterparty risk, you can access it immediately, but you pay premiums, face storage decisions, deal with insurance and security, and have less liquidity for selling. Exchange-traded funds offer paper exposure without physical possession complexity. They trade like stocks, have much lower premiums, and provide easy liquidity. But you're depending on the fund's integrity, the accuracy of their reported holdings, and their ability to deliver physical metal if you ever want to redeem. Futures contracts offer leveraged exposure but are completely unsuitable for most investors. They expire, require active management, and can generate significant losses that exceed your initial investment. For most investors seeking precious metals exposure, the choice is between physical holdings and ETFs. At current premium levels with mint delays, ETF exposure may be more cost-effective for new positions. However, this means accepting counterparty risk. There's no universal right answer. It depends on why you're buying, how much you're allocating, and your personal preference for direct ownership versus convenience. Everyone wants to know when to buy. The uncomfortable truth is that nobody knows, and anyone claiming to know with certainty is either deluded or dishonest. Market timing consistently is nearly impossible. Some investors get lucky occasionally. Nobody gets it right consistently over decades. What successful investors do instead is focus on process. They determine their allocation targets, they add to positions when risk-reward is favorable relative to their time frame, and they maintain discipline regardless of short-term price movements. If you believe precious metals should be part of your long-term portfolio, then buying some at $90 might be reasonable, even if prices go to $70 before going to $110. What's unreasonable is trying to perfectly time the bottom and top. The alternative is to wait for a correction. Silver will correct at some point. It always does. If you're patient and willing to potentially miss further upside, you can wait for a significant pullback and then initiate a position. Both approaches are valid. What's invalid is waiting for a correction, then refusing to buy when it happens, because fear dominates and then chasing prices even higher when momentum returns. This pattern repeats constantly among retail investors. Don't evaluate precious metals in isolation. Consider your entire financial picture. Do you have adequate emergency savings? Is your debt manageable? Are you contributing to tax-advantaged retirement accounts? Do you have appropriate insurance? Are your core equity and fixed income allocations sensible? If you're neglecting financial basics to chase precious metals momentum, you're making a mistake. Silver should be a component of a diversified strategy, not a replacement for fundamental financial planning. For most investors, the order of priorities should be emergency fund, high-interest debt elimination, retirement account contributions, diversified core portfolio, and only then alternative allocations like precious metals. Let me now address specific behavioral mistakes that destroy wealth during volatile markets. These aren't theoretical. These are patterns that repeat in every cycle, causing predictable pain for those who don't recognize them. Trading based on emotion rather than strategy is the single most wealth-destroying behavior in markets. When you feel intense excitement, fear, or urgency, that's precisely when you should slow down and do nothing. Prices hitting $90 creates excitement. Watching your position increase in value feels wonderful. This feeling makes you want to add more, to maximize gains, to not miss out. This feeling will cause you to buy at the worst possible times. Similarly, when corrections happen, fear dominates. Watching your position lose value rapidly creates panic. You feel compelled to sell to stop the pain. This feeling causes you to sell at the worst possible times. Successful investors develop the ability to ignore these emotions and follow their predetermined strategy. This is extraordinarily difficult and requires practice. Using borrowed money or leveraged instruments to amplify gains is a seductive trap. When prices are rising, leverage seems brilliant. When prices reverse, leverage destroys accounts. If you're considering using margin, futures, or leveraged ETFs to gain precious metals exposure, stop. These instruments are inappropriate for the vast majority of investors. They appear to offer faster wealth accumulation, but primarily offer faster wealth destruction. The mathematics of leverage are unforgiving. A 50% decline in a 2x leverage position wipes you out. Silver is volatile enough to generate these moves quickly. Only buy what you can afford to own outright. This limits your gains, but prevents catastrophic losses. Once you own an asset, you unconsciously seek information confirming that you made the right decision. You pay attention to bullish analyses and ignore bearish ones. You remember facts supporting your position and forget facts contradicting it. This bias causes you to hold too long during tops and buy more when you should be reducing. It prevents you from adjusting to changing conditions. Force yourself to actively seek contrary opinions. Read bearish analyses on precious metals. Consider scenarios where your thesis is wrong. This doesn't mean abandon your position, but balanced information input improves decision quality. During momentum markets, promoters appear everywhere. Some genuinely believe their optimistic projections. Others are talking their own positions. Many profit from advertising, commissions, or premium charges while taking no market risk themselves. Anyone guaranteeing specific price targets is either incompetent or dishonest. Nobody knows where prices will be at specific future dates. Anyone using phrases like can't lose or guaranteed returns should be ignored immediately. Seek information from sources that explain their reasoning, acknowledge uncertainty, discuss risks clearly, and have no direct financial interest in your specific trading decisions. The opposite mistake is consuming endless content, reading countless analyses, and never making a decision. Some investors research so thoroughly that they never act, then regret missing opportunities. At some point, you have enough information to make a reasonable decision. Perfect information doesn't exist. Perfect timing doesn't exist. Make the best decision you can with available information, size your position appropriately for uncertainty, and then live with the outcome. Obsessively checking prices, reading every article, and constantly second-guessing yourself creates stress without improving results. Precious metals held for less than 1 year face short-term capital gains taxes at ordinary income rates. Physical metals may be classified as collectibles with higher rates. ETFs have different tax treatments. These differences significantly affect after-tax returns. If you're making trading decisions without considering tax implications, you're reducing your real returns. Consult with a tax professional about your specific situation before making significant moves. Silver's volatility is not the same as fundamental risk, though they're related. Volatility means large price swings. Risk means permanent loss of capital. If you buy physical silver and hold it for decades, short-term volatility is irrelevant. The metal doesn't disappear. Your number of ounces doesn't change, only the price changes. However, volatility creates psychological risk. If volatility causes you to make poor decisions like selling low or buying high, then it creates real risk for you. Know your emotional tolerance for volatility before taking positions. Paper losses feel very real, even if you don't sell. Size your positions so volatility doesn't drive emotional decisions. If you hold physical precious metals, security becomes your responsibility. Don't post on social media about your holdings. Don't tell acquaintances what you own. Consider a safe deposit box or high-quality home safe. Ensure proper insurance coverage. Physical metal creates theft risk that paper assets don't. People have been robbed, had homes burglarized, and experienced losses because they didn't take security seriously. This isn't paranoia, it's prudence based on real incidents.